Welcome to the Dividend Talk podcast, episode 71. Quarter three earnings continued. Hey guys, welcome back to another episode of Dividend Talk. This week we're going to talk about the earnings of four companies. We'll talk about BASF, Texas Instruments, Microsoft, and my darling Shell. If you're new to this podcast, please go ahead and like us on Facebook, on Spotify, on YouTube. That's how you'll never miss a show. See you on the inside. Hey, European DJI. How are you, buddy?
I'm doing very well, thanks, EMF. I mean, we are a day earlier this time because I'm going for a long weekend away. I don't know how it is in Ireland, but it's All Saints' Day here on the 1st of November on Monday, so it's a bank holiday. I think it's Halloween called in American
Yeah,
style. Yeah.
we had our Halloween bank holiday Monday gone, so
hmm
we're a week ahead of you in terms of the bank holiday.
Okay. I would like to tell you, in Poland, it's really nice, right? So what they do is here, everyone goes to the graveyard, literally everyone. And on Monday or Sunday or Monday, you cannot walk there. But everyone turns lights on, and people go then in the evening to the graveyard. So it's like fully lit up.
Yeah,
And it reminds me always a bit this movie from Disney movie about Mexico and as well for the kids. So I can really say it's a tourist attraction almost. It's really beautiful.
do kids dress up and go trick or treating or?
There are some that go from door to door, but not really. It's not like that. No, we take the kids actually to the graveyard. So, for instance,
No.
last weekend we were all cleaning it. Everyone is cleaning the graves and everything, and then buying the nicest candles, and it's really nice habit here.
Yeah, we go door to door trick or treating, so we get loads of candy, loads of sweets,
hmm
and then we go to the bonfire. So there's huge bonfires around. So you get all your sweets, you go to the bonfire and you sit around and
Cool.
you enjoy with family. Or if you're a teenager, you have a few drinks. But it's no, it's nice time of year,
Yeah.
and always look forward to it. The only bad side about it is the clocks go back the way, so it gets dark really early now. So we're starting to get dark.
Yes,
Start to get dark
yes.
about 5:30 in the evening. So
Well, more time for blogging in the evening.
yeah, of course. So let's look at some of the news this week. There's plenty to talk about, and one maybe you might know a little bit more, which is the Facebook is changing its name into Meta. I
Yeah,
don't know
yeah.
how I feel about this.
I don't care about the feelings. I mean, I care about your feelings, but not about Meta. So, to be clear, it's not a dividend stock, right? But I find it interesting because I own some Facebook in my 10% part of the Met money side of the portfolio for growth stocks. I really like Facebook. It's a cash machine and it keeps on growing. And I think this is a really bold vision. So the metaverse, because that's what the name relates to, right? Meta, for people that don't know it. Facebook describes it as a set of virtual spaces where you can create and explore with other people who aren't in the same physical space as you. So, we had, think about virtual reality and such and augmented reality.
Yeah,
I think we had this. How was this called again? Several years ago, where we had this online world, where even governments and town halls started to create I don't know, a service there. They paid money for it, and it went almost straight away, like into nothing, and lots of money wasted. How was it called again?
I don't know. It's like
Okay.
SimCity or something.
Yeah,
I don't
it
know.
was it was something like that. I forgot the name, but I think this is really cool. I saw in the results they want to throw 10 billion at it. It's a lot of money, so they seem to be really convinced. I'm still really doubting whether it will be this big. I'm thinking about just how society will need to change to adopt to this. And I think we will have a lot of health discussions as such when people are all the time with these glasses on their head or something like that.
Yeah,
And in a virtual reality space, I think it will really create societal issues, at least adaptation. So I don't know if the world is actually ready for what they are doing, and if they aren't too early with the amount of money they are throwing at it. But they see it as the next big thing, and that's why they are positioning themselves there.
yeah, yeah. Look, you can see why they're going down that route. As we said, we know it's the next big thing, but I'm like you. I mean, we use some of these things in work. I don't know if you use them in your place, and you have glasses, and that means someone else can see. And oh man, I hate them. I mean, they're so clumsy and awkward. And I know they'll get better over time and stuff. But as you said, at the moment, I think social media has a huge part in mental health, and now we're
Mhm.
going to possibly isolate people even more, where they don't they won't need to actually go and meet people ever. They just need to just go on social
Exactly.
media and put on a headset, and it's such
But
a
I can tell you,
dangerous way.
I would have a six pack there without training.
I would have
Yeah.
I would have a six pack, and I would have virtual dividend cash flow every single day.
Ooh, yeah, paid via Bitcoin. But I can tell you, someone spending 10 billion, it goes somewhere too. And I can tell you who will be the receivers of a large chunk of the money.
Oh,
And that's high performance computing. And who is delivering those chips and everything? We're talking about Nvidia, AMD. So if you want to bet on this, I would rather bet on the chip industry
yeah.
and on ASML and such, because if this is going to explode, Facebook might be one of course, the one collecting the money, but with the chip makers, you're more safe, I think, on this bet.
Come on, old Pat, get into gear now and get get onto Facebook.
Exactly, exactly. So that about Facebook, I think it's really interesting. And it's a bold move. They have the cash,
Yeah, I mean
and
they have the money.
time will tell if it creates a return on investment. These are typically winner takes all
Yeah,
investments. So yeah, it's worth a
yeah.
try, I think. And the
Okay.
next news is more closer to home because Royal, the Dutch Royal Shell, is having a hedge fund on their back, right? I think they bought for, what was it, more than 500 million of shares. And they are advising and recommending Shell to break up. So they would like them to split off the new energy business, let's say, from the oil and gas business. And personally, I find this a really bad idea. I look at it really simple. They need to transition into another I sit into with the new energy, right? And they
Yeah,
need cash cow for that. They need cash flow because this will be really expensive. They will need to acquire big companies probably because Shell might not have the invention power here.
yeah,
So they need this. And if they start splitting up, you get like one will be really risky and the other one will be treated as a tobacco company, which is done already. But I find it maybe a short term value creation that you get a bit of capital appreciation. But in the long term, I don't see any value in it at all. I rather would like to see the oil and gas business nicely funding the whole future business here and slowly transition into it.
yeah. I mean, this hedge fund comes in. I think it only opened up a position, what, second, third quarter,
Hmm.
albeit a large position, about $1 billion, and now they want to go and split up a company. Like, surely, if they're investing that amount of money, there must be some discussions going on behind closed doors where this is on the table. It might not be fully agreed, but it has to be on the table. Otherwise, I don't see why they would invest so much money.
Yeah, exactly. And let's, what is it? Shell has a 160 billion market cap, also to put it in perspective.
Yeah,
But okay, they have something to say there. Um, really, really simple. I think Shell will not allow even for it, knowing Uncle Ben van der Burde. So he responded really nicely to it. He was also a bit fed up with the Dutch pension fund withdrawing their investments in
yeah,
Shell. And this is a bit what we spoke a bit before, like the woke culture that's going on. I think retirements will be even more poor at the moment because being out of oil and gas with the dividends and the passive income that also pension funds need,
yeah.
It's giving you more return than a bond. And it's a little bit this pressure now. You know, my feelings here, it's a bit hypocrite, ESG, because, it allows, I don't know, Volkswagen to be in there,
Yeah,
and all these scandals. So it's really, really hard to draw a line with this. And I think actually Shell is a leader at the moment with Total Energies. We need to respect where they are coming from. I think the fact that there was this court decision pushes them in the right direction.
yeah,
We shouldn't be hypocrite as well, because without oil and gas, society cannot run today. It's
exactly, exactly.
impossible.
But hey, I think it's a nice time to maybe speak a little bit about Shell earnings.
Mm.
I know we had them maybe last, but we're just skipping to the front.
Yeah, what I mean, I love their earnings. So what I find brilliant, right, in this time, because I think there's also this summit going on in Glasgow soon, this climate summit. They are just saying that their earnings were fewbar, yeah, effectively. So their earnings were impacted below expectation, but their cash flow, it's unbelievable. It is like they won the jackpot. They had the best cash flow from operations ever, just ever, yeah, in their history.
Wow.
It's like really, really, really insane at the moment with their cash flows. And their free cash flow at the moment of 12.12 billion in a single quarter. They reduced their debt from 65.7 to 57.5 billion. And last year around this time they had 73.5 billion in debt. So their gearing now, and that's a measure that they have, is 25.6%. It's kind of a little bit like solvency. These are really good numbers. It's below their target, and they continue to how is it, to pay down debt while they're also paying healthy dividends again, because the dividend yield is now like 4.6%. They had share buybacks again of almost a billion, which gave us another 0.6% of shareholder return in the quarter. Free cash flow then, organic free cash flow 11.1 billion, and you need to know this 1.43 per share, yeah, and the trade's currently around 20 euro. So I mean, these are really, really strong cash numbers. They of course sold the Permian base, yeah, for, what was it, 9.5 billion. In
Yeah,
the next in early in 2022 we will get 7 billion of that distributed back as shareholders. I'm still unclear whether it will be dividends or buybacks, but this is at the moment a cash machine. So I keep reiterating myself, and you may disagree with me, everyone who listens, but I tell you, we should stop thinking about $100 oil. This is something we used more than 10 years ago as an indication of peak oil or something like that.
yeah,
But with what happened since 2016 of the oil crisis, their cost per barrel are really much more down at the moment, and $80 is the new 100. So at $80, they are already generating more cash flow than they had ever in history. So if we are talking now about getting to $100, these are still the people, the analysts from 10 years ago. We
yeah.
don't need that. Yeah. So
It's crazy, right? So I didn't look at this earnings, only listening from you, and you send such a positive message, and looking at the numbers, looking at the cash flow, looking how much cash to generate, it seems really positive. And then we have the share price down about 5% today.
yeah, because the headlines of the analysts are that the earnings were, I don't know, half a billion or a billion below estimates. But who sets the estimates?
Yeah, man.
The fucking analyst himself.
Yeah, yeah,
Yeah, so who cares what they think? I just look at the facts and the figures. I understand why it is. Uh, they also had quite actually a positive impact from gas prices and trading and hedging and everything. You need to see through it, all of these headline numbers. You need to just do a little bit of due diligence and form your own opinion. For me, Shell is a company where you need to look at few things. That's reserve life,
yeah,
which I cannot look into now because I need to wait for the annual report, and mainly cash flow and solvency. Yeah, cash flow and solvency are excellent at the moment. Actually, I expect higher cash flows even next quarter. Yeah, they're more than excellent, and reserve life is under pressure, I believe, because of the sale in the Permian basis. That's the only risk I see here.
yeah.
I don't even look at the income numbers with a company like Shell. It almost makes no sense for me looking at that. It's just noise.
Yeah, yeah. But then everyone gets bogged down on earnings miss, earnings beat. I mean, come on, just read a press release. Just read. Open up the. You don't even have to read it. Just look at the investor slides presentation.
Yeah.
Click through it. You get a sense of it. But it was just interesting that I was expecting this to be quite poor. Well, initially I was expecting a good one, but when I seen the price drop today, I was assuming something bad was in there. But I'm glad listening to you that there's not
It's
a
even
great.
worse. 7 October, Shell gave already a heads up that there were some items coming up. No surprise at all. We just didn't know the severity. So really, really st- stop watching CNBC headlines. Always go to investor relation website. Of course, you need to know what to read because also companies like IBM, they really fool us, right, with the numbers. So if you don't trust that, then just listen to Dividend Talk. We'll got your back.
Yeah, we'll guide you. We'll guide you.
Yeah.
Okay, let's stick with European companies. We're on a bit of a roll at the moment with European companies. And one that I looked into was BASF. Now I have to admit I don't have a position in them. I know you mentioned them. I don't know if it was last earnings or before, and I'm always quite interested in them because I don't have many of these types of companies in my portfolio. Um, they were badly hit by the pandemic, which we knew, and we expected them to come out strong, which is exactly what they've done. So sales is up nearly 6 billion um, this quarter compared to quarter last year in 2020, which is quite significant. Sales increased a massive 42%. But the key thing here, volume was only up 6%, but an increase in prices was 36% of that sales. Like, so that's massive. Their
Now you
EBIT.
know. Now you know the source of inflation.
Exactly. I mean, you have to have companies on both sides, don't you? You have to have,
Exactly. BASF is your best inflation hedge, I can tell you.
and we talk about Kimberly Clark who's struggling to pass it on to their customers, and BASF are
Exactly.
just like, "Fuck you, customers, you're paying for this." So,
Exactly.
but I know it's incredible to actually see that in writing. Their EBIT before special items rose by 1.28 billion, which is massive considering that their total is 1.8 billion. So it was actually a huge amount. That was mainly driven by the chemical segment, which was really strong as usual. Their net income was 133 million, which improved. Their earnings is up from last year, which wasn't hard because their earnings was negative last year. It is now back to being positive. Their net debt increased to 2 billion, which is not so great, and their free cash flow. The free cash flow is down, primarily due to lower flows from operating activities. But two pieces of information kind of stuck out. So they have a joint venture with Shan. I think that's the name of the company. So they have a joint venture with them, which they are looking into batteries in the electrical vehicle market, which I think is really, really smart, really clever. We know the EV market is thriving now, and it's going to become more and more. So I found that really interesting. And they also purchased a 49.5% stake in a wind farm. So Vattenfall's Holland is a wind farm, which to me is also really good. So we know these are an ESG company. They pride themselves on that. So they're getting a little bit more into renewable energy. They'll possibly use that renewable energy within their own productions and lower their own costs and increase their own margins. So I think it's a really positive outlook from them. I mean, from the last 2-3 quarters, I've started looking at them. They're kind of like clockwork. They're kind of consistent. We do know they're cyclical, so when there is a downturn, it's going to hurt them a little bit. Like every other company, there's been supply chain issues. China, the power outages in China hurt them a little bit. So their actual sales and revenue could have been higher without those. But all in all, it's a pretty impressive quarter from them.
Yeah, nice one. I mean, I like it, and thank you for doing the homework for me. I don't even look that much at BASF. It's a tier 3 or tier 4 company for me.
Yeah.
I own like a 2/3 of a position in it. The last 1/3 is reserved for a downturn. I think I added some during in the summer when it had a bit of a a dip. Then I bought some more. It's one of those high yielding companies that I think fits in portfolios if you want to have a little bit of material and such, and industrial in your portfolio.
Yeah, it's the one thing I'm lacking. The only concern I have is they have a nice dividend yield. I think the dividend yield is about 5%. So they give you a nice yield. They have committed to grow it and increase it next year. But we do know that they have a habit of cutting their dividend. They did it in 2009. So maybe when there's a downturn or market crash, we might see that again. So I'm a little bit reluctant to get into them. I think at the price at the moment, I like them a little bit lower, but I have no real materials in my portfolio, so that's why I'm considering them.
So I'm a bit more bullish there because 2009 is already 12 years ago.
Yeah,
And we have seen last year as well that it managed the dividend really well and it showed the commitment. So I'm actually quite positive at the moment that they're really committed. And even the dividend cut, they recovered quite quickly from that at the time. So, I'm giving them more of the benefit of the doubt now after I've seen how they behaved in the pandemic. So,
yeah,
yeah.
cool.
Good. While we're still in energy, let's go then to another one. And it's a surprise one, maybe a bit, because you introduced four companies. But I also would like to give a little bit of an update on Enagas. It's a Spanish utility, gas distribution. One of the things they do is they take liquid natural gas and I said they process it into normal gas and distribute it then. And why I'm bringing this up, I've got a full position in my portfolio, tier 4, so it's not supposed to be a big position, but it yields 8.6% at the moment. Probably most of the Spanish listeners, they either hate it or they love it, because I know they're anytime when Red Electrica or Enagas pops up, they say you can't trust the government and such. And I understand exactly what they're saying, but so far I don't see evidence of that in when it comes to their let's say performance. I know that the dividend will be flat, but you get 8.6% already now. This is like almost like what most people look for, right? Here. So
Yeah,
I don't expect too much share appreciation in share price. Their numbers were actually down compared to quarter three last year. So these were not the best numbers. Their cash flow, the operating cash flow was still good with 700 million. It covered their dividends and it covered their investments as well. So from that point, it's good. But their earnings their revenue was just quite down with minus 13%. A lot of this was predicted, but yeah, we need to keep a bit of an eye on it. I just like it in general still, but these were not such a good numbers. I do believe that they are prepared for the winter and all what's happening at the moment with gas prices. They've been really helping, I think, Spanish society at the moment by the way how they've been managing the reservoir and this at the moment.
yeah,
So the Spanish gas system looks good. They should be 100% supplied with gas this year, at least from Enagas point of view. They still expect strong cash generation as per what they indicated. Nothing changed there, so dividend should be fine. Yeah, I just wouldn't like to see the revenues continue to decline like this. So it is a bit of an orange flag for me.
yeah. I think they've guaranteed a floor on the dividend, haven't they, for the next 2 or 3 years,
Correct.
if I remember. But I was quite surprised actually. And I remember I had 100 shares of these, and I sold a call option on these. And my thoughts around this, I think there's no surprise that there was huge pressures from the government coming, and we can see that in their results there, regulatory framework and pressures from that. And I was surprised on the back of that. I was expecting figures like this. I was expecting a little bit of a downturn, and yet the share price popped up €1, and it baffled me. I was expecting it to go the other way. So I'm still surprised to see it still. I know you're getting a huge yield, but I'm still surprised it's at €19. I would expect it more around the €17 mark, but I'll probably buy him just before the dividend date, which is December, I think. It's normally in the ex-dividend is normally in
Yes, it's
December.
somewhere in the last months. Yeah,
Yeah,
like a
yeah, yeah.
Christmas gift.
Yeah, I'll buy it just before, maybe 2 or 3 days before, take the 8% and sell another call option and see how we go. So let's move on to another probably boring but stable company, Texas Instruments. I'm starting to love this company more and more. Looking at their results, it's like one page. They just kind of throw everything at you, and it's like you don't need to worry about us. We're doing what we're supposed to do and move on. But I'll just give you some of the highlights. They reported third quarter revenue of 4.64 billion, net income of 1.95 billion, and an earnings per share of 2.7 dollars. So the revenue increased 22% from this time last year, which is quite good considering they're just a calculator company. Not really,
Yes,
but
exactly.
it's still quite impressive. The analog revenue is really strong. That grew 24. Embedded processing grew 13%. Cash flow from operations is up to 8.5 billion, but more importantly, free cash flow is 7.1 billion. So looking at their dividend, they pay about 53% of that in dividend, and then they do share buybacks. They already increased, as we know, a huge dividend hike in September, and they've increased their outlook as well for the year. So overall, business as usual for them, and they're just plowing away as normal. So it's probably one of the reasons why I keep buying one share of these every month. They're just more and more like clockwork. And as I said, there was no nonsense in there. Like normally there's huge presentations or the fluff, no nonsense. Just give you the facts and move on. So quite a good show out from them again.
And yeah, I love this company as well. And I remember looking at 2, 3 years ago around dividend yield of 3%, and I feel like they make calculators. Let's pass on. It's a dying business. If I see now where it is now, oh my God, what a miscalculation from my side.
Yeah,
I was probably using Casio, and I checked Casio the other day, and it's been just declining revenues like 30% year over year because they stuck to calculators. Anyway, what I find impressive here, right? We look at Intel and such, and and this may be also a little bit for Texas Instruments. Intel has been under investing, right? So they had always really high free cash flow because they had hardly any capex, capital expenditures compared to the operating cash flow.
yeah,
Texas Instrument has the same here. They have really low investments at the moment. The only thing when I see this, when for instance like there's just a capex yield of 15% or something like that towards the operating cash flow, I'm wondering like, is this really the level of investment that such a company needs to stay competitive here? I know they don't make the high-end chips like Nvidia does or something like that. These are just things that will be my only question mark to Texas Instruments, whether they aren't underinvesting for the future. But clear as now, they have all the wind in the sails, and this company is rocking it at the moment. Really, they're amazing.
it would be good actually to do an analysis between these and Intel when Intel were really rocking it maybe 10 years ago and see the comparisons. I know you mentioned they were under investing and
Yeah.
see if maybe there might be some trends that we could spot early.
Yeah, because for instance, I did a video on Intel last Sunday, and then I see these other videos online, and again, one video from Everything Money, and what they do, they don't read the forward guidance where the CEO is already really clear about how much cash flow or how much capital expenditures they will spend, and they by no way they can reach the same free cash flow levels as the last years, but they are then extrapolating a little bit, or they say, we assume that they say the worst case scenario, the cash flow stays flat,
Yeah.
but it won't even be flat. It will be much more down because of all the investments, right? So I believe we should be much more conservative in our analysis towards Intel because those free cash flows won't come back for the next few years. Maybe if one of those new products is really like hitting the shelves and really be big sales, they might have it. But there's so much risk behind that to use this as kind of your foundation. I find it too risky to look at the valuations of Intel. So this it will, for me, Intel's really nice case study at the moment because it has this like turnaround flavor all around it. Great
Yeah.
CEO, but can they do it, right? That's
Can they
really
do
what
it?
it is
Yeah.
about.
Can they do it? And as we said, it won't be this year and it won't be next year, but
Mhm,
it'll be 2 years from now is when we should start to see whether our thesis comes true or not.
exactly. It's really nice going from energy today into materials and such, and industrial into calculators and chips, and now to the cloud, right? Next gen. So we're really going from source to end product almost, because the next one is Microsoft. And I'm really falling in love with Satya Nadella. I'm really starting to change my gender preference when I'm listening to him. It is like in the call. I mean, I'm falling in love with this guy. Just when he speaks already, you should just dial into one of the recordings and he just start. And again, for 10, 15 minutes, he's telling about all the sales they are doing, the businesses that are starting to adopt Azure. And then you hear the numbers later from Amy Hood that brings me back to my own gender preference. And she starts saying revenue 22% up, 45 billion, yeah, in a single quarter. I mean, net income, 20.5 billion, and then 70.2 billion non-GAAP. These are really big numbers, right? And the non-GAAP then, because it's more conservative in their numbers, 24% up. Earnings per share 2.27. Yeah, so let's do times 4. You're talking now about $10. Yeah, I bought the shares for the first time at $40. I'm now having on the most of my shares, I'm having like a 25% earnings yield on cost. It's crazy what this company did in 4 or 5 years. And by the way, it's by far my largest company in my portfolio. But then if just also, I believe somewhere LinkedIn, they paid 16 billion for it. I was wondering, how will they ever earn money from LinkedIn? Because of a few recruiters paying a license there. 39% up again in earnings. It is insane. It's insane. I believe it has paid itself already like several times back. Just LinkedIn by itself on its own will be already like probably a top 100 company in the world. It's insane, these numbers. I'm really really amazed, and it continues to grow. And we were speaking a bit before the show, but I think at the companies where we work, we know we're still not everywhere in the cloud. And then we are talking about the metaverse. What do you think that they need in the cloud and
Yeah.
everything? I still think we're still in the early days. Not sure when when the earnings will decelerate from companies like Microsoft, right? But we have so much room to grow here, and when it comes to cloud businesses and such. So it's I wonder when it will be a 10 trillion company, really.
Yeah. Look, always impressive. I remember when you were listening to their earnings call during the week, and I just said, why bother? They should just put out a statement. We smashed it out of the park. Go on with your day. Looking at their figures, it's incredible. There is one thing that's letting them down, and that is surface revenue was decreased 17%. That's the only, like, you look, there's about what, 13 line items there. Everything is increased nearly double digits. It's
Yeah.
just it's just incredible what they're doing. I'm a little a lot jealous that you got to buy them at $40. I'm not doing too bad. I got them at $200, but I mean, it's been
Look at
incredible.
$200. You're still doing really well.
But I said to you before the show, and
Mm,
we spoke about this. I said, like, it has to stop sometime. Like, nothing goes up forever,
yeah.
and I feel
True.
like when they have a quarter, which they will eventually, which will be stagnant or declining a little bit, we might see some turbulence. People might panic because they're just so used to seeing these kind of
Yeah.
numbers. But
But
for the
but but
moment,
then okay, let it fall to $200. Let's
yeah, I
assume
mean,
that. Let's get it back to $200. We're talking then probably what is it? About a PE of 20 for a company like Microsoft. Yeah, it will be a steal at that time because it will not like go to zero growth overnight. Yeah,
no.
this is a slow compounder. So and they can always do price hikes still on the current portfolio
Yeah.
when with all these companies having lock-ins. I mean, this is more organic growth, but once organic growth slows down, they start price hiking all these lock-ins. I mean, this is like a decade long of revenue growth in front of them. It's not stopping anytime soon, in my opinion. And then all the companies doing digital transformations everywhere.
They are almost the perfect dividend growth stock.
For me, they are. For me, they
Yeah.
are. If I look at my yield on cost, it's
It's insane what you
I
have,
I
yeah.
I don't I know it's probably now 0.5% of yield. I know, but for me, it's not, and it will if it continues to grow with 10-15% dividend for the next 10 years. I mean, I just hear every month, every quarter, ka-ching, ka-ching. Yeah,
Yeah. Look, I think we spoke enough about them. We're
yeah,
huge fans of
that's
Microsoft and
yeah.
what they do. I think they're incredible. So well done you for getting in so early.
Good. Thank you. So these were the earnings from us, guys. We had to pick few. ExxonMobil, Dividend Aristocrat, $1 cent increase in the last
Told you
quarter that they had the opportunity. Yeah.
they could not let that pass. Come on. This
No, no, no.
they know that people invest in them for the dividend and for that status that they have. So if they fuck that up, we would have seen their share price tumble.
Yeah, so we don't need to know the earnings anymore. We're already satisfied. So tomorrow, ExxonMobil, who cares? Yeah. Let's go to the next section of this podcast, the portfolio review. And this time we have the volunteer called Pinto, and his top 5 holdings are number 1, AbbVie, number 2, Bristol Myers, number 3, Walgreens, number 4, British American Tobacco, and number 5, Verizon. He's still in the early stage, so he's welcoming any ideas and recommendations.
So looking at this, I own AbbVie, Walgreens, British American Tobacco, and Verizon. Okay, and I know Bristol Myers is a company you know a little bit more about. So the 5 companies we know pretty well. I don't think I would have them as top 5 holdings. Each of these are, and maybe as you said, he's in the early days. Each of these, in my view, are either value plays or turnaround stories, or have been deeply depressed because of high debt such as AbbVie or Verizon or Walgreens that are turning around. So I don't see them as top 5 positions. As I said, I have 4 to 5 that are tier 2, tier 3. Well, actually, they're all tier 3 or tier 4 for me. None of these would be any higher. I like them all. They're all good dividend paying, dividend growing companies, but the 4 that I mentioned all have risks associated to them. And
Yeah.
I would prefer to have top quality companies in my top 5, such as Microsoft, Texas Instruments, Johnson Johnson, and maybe have these hovering above them. But nothing wrong with them. And as you said, you're in the early stages. I can see the attraction. I can see why you'd buy them. Um, but I'd probably focus on more solid companies for my top 5 going forward, maybe.
Yeah. So, but it's I would actually have a question to Pinto that would probably be my best recommendation that I can have, and that is ask yourself, are you chasing yield? Why I'm asking that? Myself included, and many dividend investors include others in the beginning, they they make the mistake, and we only find it out afterwards that we were chasing yields.
Yep. Yep.
Reason why I burned myself on Tupperware, General Electric, I was chasing yield there, and I think many people that are more seasoned in dividend grow investing would recognize that. And although I see, for instance, that British American Tobacco, I find their dividend really safe. AbbVie at the moment, no worries about it either. Bristol Myers, actually also neither. These are biotech companies, so they have to do with patent expiration, and that's the risk. But I'm missing here a little bit probably consumer staples or other companies that should be the foundational stocks of your portfolio. And here I would ask yourself, Pinto, what are the top 5 companies that you could dream of now that you would see being much further and better 10 years from now, and that also pay dividends? And start looking at those. and think if some of those might actually more deserve a position here, and don't look only at the yield making that decision.
Yeah, I'd agree with you, and we all do this at the beginning. We all get caught, and it's probably why I started looking at some of these companies. But I mean, we all know I'm a huge fan of Walgreens, but they are not even in the top 10. I think they're the 11th in my portfolio. Um, AbbVie is even lower again, and Verizon is so small it doesn't even show up my pie chart. So I
Yeah,
mean, they are they're classic. I suppose when you're on dividend groups, and I've seen this more and more on Twitter and on Facebook, particularly Facebook, and you've seen lots of people throw in lots of ideas, and they seem to throw in the same type of companies and same type of ideas. IBM is probably classed in with some of these companies as well. Companies
yeah,
that historically have grown their dividend, but you're not looking at the fundamentals behind them. So
yeah. But
uh,
that's also the issue, because companies without issues at the moment, the yields are sometimes
that's
below
yeah,
1%. So I
yeah,
understand it fully, and that's why it's really hard at the moment to start dividend investing, because it's so much harder at the moment to find quality companies. But for instance, we know Thiago, he did a lot of homework on AFLAC.
yeah.
AFLAC might really, really fit nicely here, as an example. So ticker symbol AFL, which I think has way less risk associated as a company than the top five here.
Yeah, yeah, I'd agree. Obviously, we have no context over goals, how long you've been doing
Mhm.
this, or anything like that. So it's purely an observation on the five holdings you gave us. But we'd love to hear from you. Just elaborate a little bit more about what you expect, and why you chose those five as your top holdings.
Good. So Pinto, good luck. Thank you. You know where to find us on social media. Feel free to ask any follow-up questions or to provide further context. We love these kinds of engagements, so don't be shy. Don't be a stranger. Okay, so let's go to the listener's question then. And the first one is from Miłosz Markovic. And he says, all my best performers were both at all-time high. I sometimes think it's pointless to search for deals. Maybe we should just buy a strong business with growing revenue and margins and just keep on buying. What do you think?
I mean, it's quite funny. I haven't seen these questions, okay, and this relates back to
Yeah.
Pinto's portfolio absolutely perfectly, and it's something that I'm struggling with. I've realized a couple of things, right, and one is I I I can't value companies. Okay, we can do this dividend discounted cash flow, we can do dividend discount models, but really you're making a lot of estimates that may or may not be true, and every earnings or every year they're going to change, right? And you have companies out there that spend millions, and they have analysts that do nothing but analyze prices of companies. So sometimes I feel like I should just stop trying to find a fair value and just do what Markovich said here, is just pick strong businesses with growing revenue margins and just buy them, because in the long run, that's what will win in the end.
So this is what the Kleine Kapitalist is doing with ASML, and he calls it his hooker money. Yeah,
Yeah, yeah,
because
he
he's just
does. Yeah.
throwing it at hookers. That's how it feels for him. I hope his wife is not listening and that they are driving in the car right now. Sorry. But look, tell me when you start doing it, EMF, when you start following that approach, because that will be the moment I will stop investing, because it probably means that we're at the top at the cycle.
Okay, I will tell you first. Okay, I will tell you first.
Thank you, because that's when I will start buying put options on the S&P 500 when you start doing that.
I might start doing it soon because I really want the crash to happen.
Good, good, good.
Yeah, but I look, it makes sense, doesn't it? It makes sense in theory. It's so hard. It's so hard to follow in practice. It really is. Okay, Centrino has asked us, ticker symbol OHI is again dropping in price below $30, and the dividend is maintained. Is it a buy or still a hold?
Well, I get this question a lot because we're talking here about Omega Healthcare, which is American real estate investment trust, and it's kind of your end of life room where they store you in the last few weeks before you die, effectively. So it's really for such kind of care. It's a lot depending on governmental programs like Medicaid and Medicare. This risk is all the time there, and that's why you see that the share price is all the time under pressure, because their customers, some of them are really, really in problems, right? So the question is like, I said here, is the buyer, is it still a hold? I typically say below 30 in the high 20s. It's interesting for me generally. There's risk associated, but the dividend is around, what is it, 8, 9, 10% almost. So it's a high yield. And that's usually like with associated risk to it. I have a full position already for many years, 5 years or so. It is giving me one of the best dividends out of my whole portfolio. And for these whole 5 years, the risk was the same. When Trump came, they thought like Trump will kill all this Obamacare and everything. So this company will be in trouble. Now it's Biden. I think the system there is too complex for this. So I'm not going to say it's a buy or a hold. I bought always around the 30s, and I learned that I could better buy in the high 20s. That's
Mm.
kind of my thinking. But in the end, Centrino, just do a little bit of homework here, just a little bit by checking like price to FFO and such, and how well the dividend is covered. At least
Yeah.
check those two things, and you should be fine.
Okay. Cool. Wolf of Harcourt Street, thoughts on Facebook changing to Meta. I think we've answered that in our
Yeah,
earlier.
exactly.
Tommy has asked us, do we have any comments on SAP earnings? I didn't see it, so I
No?
have no comment.
Okay, so I checked them the other day. They were good. From SAP point of view, they were good. I owned like really, really few shares. Like a while ago, I sold them. I learned I don't need them in my portfolio. But other than that, earnings were good. So I think the price is still not too high if you want to start nibbling in. Earnings were good. But what was it? 20% growth, if I remember correctly. They're just starting with their cloud. What they are really
Yeah.
doing is transitioning their existing clients into the cloud. So they take, the infrastructure costs away from the company, from the client, and take them in-house and charge more. These are not the earnings growth that the hot shots are making. So that's what you need to take into account. Other than that, they were pretty good. And, if this is a start, it was at least a good start.
Cool. So there's a question from Martin, and he's asked us, what is the best free, because he's Dutch, and I can understand that talking to you. What is the best free portfolio dividend tracker? He's now monitoring with Excel spreadsheet, and he wants better.
So first of all, I would say the best can only be mine, of course. No, no, but to be honest, I created a full dividend tracker, dividend portfolio tracker. It's available via my website. You just need to leave your email behind and subscribe so that you get updates. You get then a download link to the tracker. It's a Google Sheet, and that's it. But I know, because I engaged a bit with him on Facebook with Martijn, he's looking actually for an automated application. And in this case, I would give Wallmine a chance. So it's WALLMINE.com, Wallmine. You can load there your portfolio. You will need to take it from your broker in CSV, because we're not like America that we can just link our banks that easily. Download it. You might need to prepare it a little bit, but it has a good bulk upload function. You can get it in there, including all the transactions. I have found that the most accurate tracker out there for European investors, also when it comes to European dividends. Sometimes they still have small mistakes. You can change them manually. I don't like their visuals too much in the application, but other than that, I find that the best. And I loaded my portfolio there one time as well, and I had a relatively positive experience with wallmine.com.
Does it add the dividends automatically once you have a company?
You can how I said, you can decide, configure that. I think it's a setting for also, for instance, reinvestment. But it's really hard as a European to automatically reinvest.
Yeah.
I mean, you can do it with trading 212, but it's one of the only ones because it has fractional shares. But with the Giro and such, you cannot do that. So and most of us therefore deploy the cash just to the next investment that we do, right? So technically, I believe you can do it, but probably most people won't use it effectively. But Martin, give that one a chance. I know you're still in your early days of dividend investment, so it might not be too much preparation work for you to start making proper use of it.
Yeah, and I recommend dripinvesting.org. I know we use them for Dividend Aristocrats and other stuff, but they have Excel sheets and G sheets which I'm moving away from. But there's also one that I came across recently, which is divvytracker.io, which is also quite good. You can upload your portfolio the same as you can on OneMind.
Mhm.
So maybe try them out and see which interface is best for you.
Exactly.
And they have all European companies on it as well, which is something which is quite
Yeah.
rare.
Yeah, it's just like they use all the same data providers, so you often cannot trust really the data in
Yeah.
there. You always need to double check with
Yeah.
these things. Okay, good. Hope it's helpful, Martijn, and also to the other listeners. We'll put it in the description of the show. EMF, don't forget it.
I'll try not to.
Good. So then let's go to the last topic of today. I will keep it a little bit close to what we discussed a little bit because the stock pick of the week for me is Bristol Myers. It's not so much that it's kind of like deep value at the moment from that point of view, but it's like I bought some shares this week in Bristol Myers. That's why I'm sharing it. And currently it yields 3.47%, 3.5%, which I think it's a nice starting yield. It has been growing the dividends over the last 5 years with around 5%. Payout ratio is pretty low, 26%. However, we should not be mistaken. It uses the non-GAAP earnings here. And the non-GAAP earnings for pharmaceutical are typically without the depreciation and amortization, so they look much better than the GAAP earnings. So it's a decision on yourself whether what numbers you want to use here. Otherwise, it's more like, I believe, 70% payout ratio. Why is the stock down? In generally, it's with patent expirations and such, which you can typically imagine here. But I've been just looking at their portfolio and their pipeline the other day, and I find their pipeline actually quite good. Now, the stock went down after earnings, but I want to discuss the facts here. Third quarter revenues up with 10% to 11.6 billion, driven by their top drugs, Revlimid, Eliquis, and Opdivo. Mainly driven, or the most revenue increase was because of Europe, sales in Europe, 8%. Gross margin 80%, so probably lots of price hikes. Yeah, that is not necessarily volume, but price hikes. So they invested what is it? They invested here this quarter 2.4 billion in new research, and they depreciated approximately the same. So they are kind of investment and amortization are kind of in balance with each other, which I like at a pharma company. But forward guidance, they expect revenues, not profits, to increase in high single digits, which is always good here. So overall, I think if you think about it, right? So their EPS guidance for the whole year is around $2.75 to $3. This, what is it? The stock trades currently around 57. So
Yeah.
yeah, so based on that, you would say it's approximately, now let's say 18 to 20 PE, which is quite okay in the given circumstances. But if you take their non-GAAP EPS, which is for them around $7 to $7.50, then we are talking about a PE of 8 or something like that. Again, you see that there's a really big difference, and it has a lot to do, of course, with amortization and everything. So you need to pick your choice here. If you go in the middle, you're still talking about a PE of 13, 14. But what I find more interesting here is that their top brands have been growing. So Revlimid, 300 million additional this quarter. Eliquis, 350 million additional, a growth of 15%. But then you also need to go into the small into the small notes of the company. And I believe that, for instance, Eliquis, they won a court case, and therefore the patent expiration is 2028. So they won a case, I think, against generic makers and such. So they won effectively, again, several more years of cash flow from this, which gives them more time to innovate in the portfolio. What I also like is that their portfolio is more and more diversified at the moment, and it starts to become slowly less dependent on their top trucks. It's not that much different like what we discussed about Roche last week. So for me, Bristol Myers, even though biotechs are really hard to assess because of their pipeline, I did some homework around my pipeline. I'm quite optimistic. It's not a top company for me that I want to be in my top 10. I've placed for 40 stocks, but let's say from number 20 to 40, it definitely deserves a position there. So those are my thoughts about Bristol Myers. I'm slowly adding there on the dips.
Okay, nice pick. I'm not overly familiar with the company, and as you say, I would not know anything about their pipeline looking at it, so I'll trust your judgment on this one.
Good.
Yeah.
Thank you for the confidence in me.
You do a good job every now and then. Okay, thanks for the stock pick. And as usual, thanks to all our listeners. Thanks for the questions on Facebook, Twitter, on emails as well. We're a little bit slow on emails to Dividend Talk, but we are active on our own emails just in case you are writing to us. And as always, thank you, and we will see you next week.